Assalamu alaikum. Dear students, welcome back to the class of corporate finance. This is our second lecture of corporate finance, the role of financial management. We will study in this lecture that what is the financial management, the goal of the firm, the organization of the financial management functions. First, what is financial management? Dear students, I hope you have studied the definition of financial management in the different subjects such as introduction to business finance, financial management, and other subjects of the BBA. The definition of the financial management is simply concern the acquisition, the financing, and the management. These three words combinedly make the definition of financial management. The first word is acquisition, which is also called investment decision. The second word is financing, the financing decision. And the third word is management, the management decision. But every organization, every corporation who run a business, acquire the assets, finance that assets, and manage that assets, they have an overall goal in their mind. If any business have no goal, no aim, then they will not acquire any asset, they will not finance that assets, they will not need to manage the assets. So we will discuss separately every word: acquisition, financing, management, and the goal of the firm. Let me start with the first decision, that is investment decision. Investment decision is the acquiring decision, acquisition decision. In this decision, businessmen or businesses or organizations acquire assets, invest in assets. This investment decision is most important of the three decisions which we talked about before. Talked about the decisions. It's the left hand side of the balance sheet, such as current assets and fixed assets, or short term assets and long term assets. You better know about the balance sheet. You are familiar with the balance sheet. There are two parts in balance sheet. One is left hand side of the balance sheet, second is the right hand side of the balance sheet. In the left hand side of the balance sheet, there are assets which are divided into two categories, two parts: the current assets and the fixed assets, or long term assets and short term assets. And the second part is also divided into two: the current liabilities and the long term liabilities. These are liabilities and owner's equity. So investment decision is related to the left hand side of the balance sheet. Left hand side of the balance sheet. The components of the left hand side of the balance sheet are: the first component is cash, second is account receivable, then inventory, then marketable securities. These are all the assets which are easily convertible into cash in a short period of time. These are the assets which are easily converted into cash in a short period of time. And second part of the left hand side of the balance sheet is the long term assets which are not easily converted into cash, such as lands, buildings, materials, machineries, as well as the cars. These are all long term assets. We cannot easily convert into cash in a short period of time. So, this is investment decision. When organizations acquire something, these acquisitions automatically go to the left hand side of the balance sheet. The investment decision of the financial management, we answer to these three questions: that what is the optimal firm size, what will be the size of the firm. The balance sheet shows the position of the organization. The definition of the balance sheet shows the position of the balance sheet. So if the firm is large, we can know from the balance sheet. If it has large amount of fixed and current assets, we know that the size of firm is large. If the assets in left hand side of the balance sheet are small, we can say that the organization, the firm is small. So in investment decision, we answer the question, what is the optimal firm size? Second question, what specific assets should be acquired? Which assets should be required? We better know about that. That any asset we acquire on the basis of need. If there is need of acquiring the asset, we go through the purchase of that asset. We go to acquire that asset. So we have to acquire asset on the basis of need. Organizations have to acquire the assets on the basis of need. If there is no need of acquiring any asset, then they will not go through acquiring the assets. The next question is, what assets should be reduced or eliminated? It's clear, it's common sense that any assets in the organization will never work for the whole life. It will mature. If you remember the depreciation methods in accounting, and that subject we studied that every asset in the world falls in some maturity category. Maybe possible some machines are in the 3 years category, in the 5 years category, in the 10 years category, in 15 years, 20 years, but they will mature. If the asset has a long term maturity date, but again it will mature after 30 years, it will mature, then we can eliminate this asset. So some assets are able to eliminate from the organization. So investment decision teaches us the answer of these three questions. Next decision is the financing decision. Financing decision is the second decision of the financial management. Financing decision is the right hand of the balance sheet. Investment decision was the the investment decision was the left hand side of the balance sheet. The financing decision is the right hand side of the balance sheet. And what are the components of the right hand side of the balance sheet? Liabilities plus unearned equity. Liabilities plus unearned equity. So determine how the assets in the right hand side of the balance sheet are or will be financed by the left hand side of the balance sheet, will be financed by the right hand side of the balance sheet. So this is the financing decision of the financial management. Second decision of the financial management. In this decision, we answer these four questions. First question, what's the best type of financing? Which type of financing will be feasible for our organization, for our firm? Maybe possible some organizations go through the 100% for loan. They take loan from the banks. Some organizations go to the 100% for the owner's liability, its own capital. So this is the best type of financing. Second question is, what's the best financing mix? Now, most of the organizations, most of the firms go through mix of the financing decision. Mix means they provide to funds to the businesses by different ways. May be possible some organizations mix the bank loan with owner's equity, owner's own equity. 50% loan from bank, 50% owner's equity. May be possible some organizations go through the three ways. They take loan from bank, as well as they take loan from the mutual funds. They also provide some capital, owners on capital, and they may be possible they issue some stocks of their organization in the stock market. So this is called max. 25% owner's equity, 25% loan from the bank, 25% loan from the mutual funds, may be possible 25% issue of stocks in the stock market. So this is a financing mix. So and financing decision shows the teaches us the answer to the financing mix question. Third, what is the best dividend policy? If before we talked about that some organizations issue their stocks in the stock market, sell their stock in the stock market. When they sell their stocks, then the investor who purchases the stock of the organization will expect something extra on his investment. That expectations of extra is called dividend. The profit of the stock is called dividend. So organizations financing decision will teach us that how will be the dividend policy. Some organizations go through zero dividend policy. They will not pay out the dividends to the stockholders. They reinvest this amount in their organizations or in other organizations in other projects. Some organizations go through the mixed policy. They pay out 50% of dividend to the stockholders and keep 50% dividend with their self and reinvest them. Some organizations go to the payout dividend policy. They fully pay the dividends to the stockholders. So these are the dividend policies, and the financing decision teaches us that how will we feasibly keep the dividend policy in our organization. Fourth question is, how will the funds be physically acquired? From where the physically funds will be acquired? Who will provide us the fund? Stock exchange market, or bond market, or the financial institutions, or government? Who will provide physically funds to us? How we will find out the funds for your organization physically? So financing decision is related to these four questions. Okay guys, next is the asset management decision. The third decision is the asset management decision, which is third decision of the financial management. It's also important. When an organization, a businessman acquire assets, then acquire funds, acquire financing for that assets, then it will need to manage these assets. The organization, the management must manage these assets in the organization. Then how do we manage existing assets efficiently? Efficiently means efficiency. 2 plus 2 is equal to 5. It's also called synergy. Synergy. Synergy is 2 plus 2 is equal to 5. Right? It's a common sense that we know the 2 plus 2 is equal to 4. Why we say 5? Because we get benefit from the 4 like 5. If we have 4 rupees, we invest these 4 rupees and we earn profit of the 5 rupees. If we have 4 human resource, 4 people to work, we will get the work done from these 4 people like 5 persons, 5 people. So these are the efficiency. So if we have existing assets, we will manage these assets efficiently. Financial manager has varying degrees of operating responsibility over assets. Some managers go through the current assets. Some organizations go to the fixed assets. But most of the organizations go to the current assets rather than fixed assets. Before I told you, the left hand side of the balance sheet shows the two types, current assets and fixed assets. Current assets are those assets which are easily convertible into cash in a short period of time. Most of the organizations emphasize on the current assets because they have liquidity. They are liquid, easily liquidated, easily converted into the cash. So most of the organizations have more concentration over the current assets rather than fixed assets. So guys, this was the decision of the financial management. Now we are going to second part of this lecture, today's lecture, second lecture, that is the second part, that is the goal of the firm. You better know about the goal of the firm. And what is the goal of the firm? Goal of the firm is maximization of shareholders' wealth. Every organization, if you remember, in the first slide of today's lecture, we talked about that. We defined the financial management, that acquiring, financing, and management. But there is some overall goal in the mind of the organization, mind of the manager. What was that overall goal? That was the goal of the firm, maximization of shareholders' wealth. Why organizations, why managers do all these decisions, such as financing decisions, such as investment decision, management decision? Because they have a goal. What's that goal? That goal is maximization of shareholders' wealth. They maximize shareholders' wealth. So this shareholders' wealth maximization is brought by these three decisions. Value creation occurs when we maximize the share price for current shareholders. When organizations issue the stocks in the stock market, so these stocks purchased by the investors, those investors are called shareholders or owners. They are owners of the organization. So when we add value to the share price, so it means that we are maximizing the shareholders' wealth. Then what is the value adding to the share price? Value adding to the share price is that when investor purchases a stock by $1,000, after 3 months or 4 months or 1 year, the price of stocks rises to the $1,200. After 1 year, the price of that stock rises to the $1,300. So it means that we are adding to the value of share price. This adding value shows that we are maximizing the shareholders' wealth. This increasement in the price of share shows that share price shows that we are maximizing the shareholders' wealth. If an investor purchases the stocks of a organization by $1,000, after 5 months the price of that share, price of that stock becomes 900. After 1 year it becomes 800. It means that we are decreasing the value. We are not adding the value, we are decreasing the value. So this will not get the aim, get the overall goal of the organization. So we are failed to manage, we are failed to acquire feasible assets, we are failed to finance feasibly that assets, and we are failed to manage feasibly, efficiently that assets. Organizations must maximize the shareholders' price, and this shareholders' price is maximized by the adding value to the share price. To the share price. Clear? There are some shortcomings of alternative perspective. A lot of organizations concentrate on profit maximization rather than shareholders' wealth maximization. Profit maximization is good for the organization, but the organization will face some problem. That problem is could increase current profit, but it will harm the organization in the long run. Most of the organizations you can see in your society, in your country, that they are only concentrating on the profit maximization rather than wealth maximization of the organization. How? Some organizations decrease the quality of products. As decreasement of the quality of products will increase automatically the profit of the organization. So currently they are earning profit, but this low quality product will decrease the customers of the organization. So this decreasing of the customers of the organization will harm in the long run. Sometimes will come that your market share will become to zero because of your low quality products. So this is the example of profit maximization. So organizations will not concentrate only on profit maximization, but they will also they must concentrate on the wealth maximization of the shareholders. Most of the organizations concentrate both of them. Concentrate on both of them. They concentrate on the profit maximization as well as they concentrate on the wealth maximization. Clear? Next is the shortcoming of alternative perspectives, earnings per share maximization. Maximizing earnings after tax divided by shares outstanding. There is a problem. This earnings per share EPS maximization, earnings per share, not price maximization of the share. It's a earning per share maximization. They only concentrate on the earnings per share maximization. What are the earnings per share? They are maximizing earnings after tax divided by shares outstanding. The shares which are in the hand of investors, and the price of these shares. So problems does not specify time or duration of the expected returns. They will not know the expected return of the duration or time. Ignores changes in the risk level of the firm. They ignore the risk. They will not decrease the risk. They ignore the risk of the organization. Calls for zero payout dividend policy. And they go through, the time will become that they will not pay any dividend to the they will not be able to pay. They will not be able to pay any dividend to the shareholders, to the stockholders. So these are shortcomings of alternative perspective. There is a strength of shareholders wealth maximization. Shareholders wealth maximization have some strengths. The tax account of current and future profit and EPS. They also increase the earnings per share. They also increase the profit of the organization, as well as they increase the future and current profit of the organization. The timing, they also know the timing, they also know the duration, they also know the risk of the organization, they also better know about the profit of the organization, the earnings per share of the organization, dividend policy they also have, they also pay dividend to the stockholders. So, and all these other relevant factors which are related to the shareholders maximization, wealth maximization, sorry. So, which perspective is feasible for the organization? Shareholders wealth maximization rather than earnings per share maximization and profit maximization. So profit maximization and earnings per share maximization is not feasible for the organization. The organizations must go through the wealth maximization of the shareholders' wealth. Now the next topic is the modern corporations. You better know about the modern corporations. Modern corporations have two categories, two components. First is shareholders and the second is management. Modern corporations have two components, the shareholders and the management. Shareholders invest and management control that investment, manages that investment. There exists a separation between the owners and the managers. Managers are management, the owners are the shareholders. If you remember the subject of introduction to business, there we studied three types of businesses: sole proprietorship, partnership, and corporations. In sole proprietorship, owner himself works in the organization. He run himself the organization. In partnership as well. But in corporation, owners will not do anything in the organization, will not do any activity in the organization. Only management run the businesses. So there is separation between these owners and the managers. So role of management is management acts as an agent in the organization. He acts in the behalf of shareholders. He works for the shareholders. He earns profit for the shareholders. He maximizes the wealth of the shareholders. So management acts as agents in the organization. An agent is an individual authorized by another person. A person can authorize someone to run a business. So this authorized person is agent, who works on the behalf of principal, the behalf of owner. Agency theory, we also know agency theory. Jensen Macklin developed a theory of the firm based on agency theory. And economic, you can study the agency theory is the part of economic theories. So, agency theory is a branch of economics relating to behavior of principal and their agent. Jensen and Macklin developed a theory which is related to the behavior of principal and their agents. That how will be the behavior of owners and how will be the behavior of agents, management. Agency theory, principal must provide incentive. This agency theory, which Jensen and Macklin developed, says that incentives or the managements or we can say advantage for the management, incentives. Without incentives, any agent will not work, will not maximize the shareholders' wealth. So incentives are the most important for agents who will work for the best interest for the owners. If you are providing good incentives to the managers, to the agents, they will work in the best interest of the owners and will monitor and evaluate all the result of the organization. Now, what are these incentives? Incentives also called executive compensation. Incentives are also called executive compensation. The stock option. You can provide stock option to the managers, senior managers. They will become the owners of the organization and they will work in their best. If you are not providing stock option to the managers, to the agents, then you go through the prerequisites, other prerequisites, bonuses. Prerequisites are all other facilities which are related to the senior managers, senior agents. Provide them bonuses. Provide them other bonuses. Next comes social responsibility. Organizations must concentrate on social responsibility. Social responsibility is the welfare of the people, as the wealth maximization does not preclude the firm from being socially responsible. They will also concentrate on the social responsibility. Social responsibility is the responsibility of society. You must work, you must separate some part of your profit, huh? Provide some your part of profit to the societies to work, huh, in the society. Assume we view the firm as producing both private and social goods, then shareholders' wealth maximization remain the appropriate goal in governing the firm. So social responsibility is very necessary for the organization. Organization of the financial management function. The last topic of today's lecture is the organization of the financial management function. In the top board comes the board of directors. You better know who are board of directors. Board of directors are the team who make decisions, who are final responsible for the organization, who plan for the organization, who make best decisions for the organization. Board of directors, BODs, are the final responsible for the organization. After board of directors comes president, who is called chief executive officer, CEO. Then CEO is divided into three parts: vice president of operations, vice president of finance, and vice president of marketing. But we only concentrate on the vice president of finance. Vice president of finance is divided into parts: the treasurer, the controller. The treasurer is the capital budgeting, cash management, credit management, dividend disbursement, financial analysis, planning, financial planning, pension management, and insurance and risk management, and tax analysis planning. These are all activities of treasurer. Controller, they only make accountings, accounting, cost management, data processing, general ledger, government reporting, and the internal control, preparing financial statements, preparing budgets, preparing forecasts. All these activities are related to the uh, controller. This was today's lecture, dear students. I, I hope you understood today's lecture. We will meet in the next class, in the third week class, inshallah. Thank you so much. Have a nice day. Have a nice time.